example that's featured in the book. So here we have a company's income statement, balance sheet, and other information that's provided from other activities that they perform throughout the year. So whether you're starting with your direct method or your indirect method for the cash flow statement, you're going to have to go through and identify which portions of the statements are related to financing versus investing versus operating activities. So let's go through the income statement first. So here we have sales revenue. That's going to be an operating activity. Interest income, operating. Gain on sales of vehicle. So this is a vehicle that we had previously purchased or invested in. It's going to be an investing activity. So we'll code that as an investing activity. Cost of goods sold, that's operating. Payroll expenses, operating. Insurance expenses, operating. Interest expense, operating. Rent expense, operating. Depreciation expense. We'll come back to this, but this is a non-cash item. So we'll have to adjust for this in our indirect method because we're starting with total net income. We won't have to necessarily do anything with this for our direct method. Loss on sale of long-term investments. That's going to be an investing activity. And income tax is going to be an operating activity. Okay? So let's remember those. Let's start off with the direct method. So here you could say I've already done a lot of the work for us, but I want to just walk through how I put this together. So we're going to start with the income statement line items. So if you go back to the income statement, you'll see that for receipts, we have two items that we're receiving cash for on the operating activities, revenue and interest, which is here. Revenue are from sales and interest. And then we have some expenses. So we have cost of goods sold, payroll, insurance, interest, rent, and taxes. So inventory is related to cost of goods sold, payroll, insurance, interest, rent, and taxes. Now let's see how to calculate these. So again, we're starting with the income statement line item. In this case, it's going to be revenue. And then we're going to add our beginning AR and subtract our ending AR. Okay? And that's going to give us our cash from sales. So I know I told you add beginning, subtract ending. Well, let me tell you the theory about that. All right, so we have sales of $700,000 within our income statement. At the beginning of the year, we have accounts receivable of $120,000. Those are sales that related to last year, but we can assume that we received that cash during the year. So our sales number is an accrual basis. We want it to get to our cash basis, so we have to add $120,000 in cash that we received during the year. Then we have ending AR of $130,000. That means that people still owe us $130,000 at the end of the year. So we're going to subtract that from the sales number because we haven't collected that cash yet. And that gives us cash from sales of $690,000. You'll see for the accounts that there is no corresponding income statement, balance sheet balance, that the expense or income is equal to what's in the income statement. So for interest income, we don't have any interest receivable. So it's simply the amount that's in the income statement. That means that we incurred that much income, we received that much income, and we received it in cash. And then the same thing with rent. The $18,000 is what our expense was, and we actually paid that expense. And then we also have that scenario when it comes to our interest expense. There's no interest payable. All right? So now let's go to cost of goods sold. This is the tricky one that I was talking about before. Okay? So remember, you just add beginning, subtract ending, unless you're looking at an expense and an asset. So here we reverse that. So we started with cost of goods sold of $500,000. We're going to subtract our beginning and add our ending, and that gives us our cost of goods purchased. Let's think about why we did it that way. At the beginning of the year, we have $500,000. I'm sorry, for the year, we have $500,000 in cost of goods sold. So that means that we transferred $500,000 from inventory into our cost of goods sold. Well, at the beginning of the year, we already had $215,000 in inventory. So that was already accounted for. We didn't spend cash on that. We didn't purchase anything related to that. We already had that inventory, so we're going to reduce our expense to a cash basis. And then at the end of the year, we had $225, so we can assume we made that during the year, so we're going to add that back. Okay? That gives us our cost of goods purchased, and then we're going to add our beginning and subtract our ending. So that gives us $500,000 that we spent for purchases. Now let's look at our payroll. That's an expense, so we're going to add our beginning, subtract our ending. So let's think about this. At the beginning of the year, for the year, we have $50,000 in expense. At the beginning of the year, we had an account payable or payroll payable of $8,000. Okay, so we can assume that we paid for that during the year. So that's going to increase our cash spent because the expense related to that was incurred last year. And then we need to reduce for our payable at the end of the year because we haven't paid that cash yet, but we incurred that expense. We have to reduce it. So that gives us $48,000. Okay? Now here's another tricky one with insurance. Insurance is an expense, but the related balance sheet item is prepaid insurance. Okay? So we're going to subtract the beginning and add the ending, which gives us $25,000. And then that leaves us with our tax expense, add the beginning, subtract the ending. Okay. So now let's go to the balance sheet. Okay, I have to put these in on negative amounts. Sorry about that. Now we're going to go to the balance sheet and see if we accounted for all of the operating activities, non-cash operating. All right. So cash, that's going to go the beginning and ending. So AR, yes. Inventory, yes. Prepaid, yes. Long-term investments, we haven't done that yet because that is an operating activity. So that's going to be operating. All of these are, sorry, that's investing, not operating. All of these are operating. Land, that's an investing activity. Property, plant, and equipment and accumulated depreciation are both investing. Long-term investments, investing. Accounts payable, payroll, and income tax are operating. We accounted for all of those. Notes payable is a financing activity. So this is our first financing activity here. Let's see, make it purple. No purple. Whoops. Let's pick a lighter color. Okay. And then capital stock and retained earnings are both financing. However, we don't need to do anything with retained earnings here necessarily because that's accounted for as part of net income. And then we'll go back to these in a little bit. So we've accounted for all of our operating activities. All right. Now let's do our indirect method. So again, you're going to start with your net operating income, which is right off of the income statement here. And then we're going to go through all of these accounts that we highlighted: accounts receivable, inventory, prepaid insurance, accounts payable, payroll, and income tax. Okay. And we're going to look at the beginning of the period, the end of the period, and calculate the change in the period. So if we have an increase in accounts payable, is it going to be an increase or decrease in cash? An increase in an asset is a decrease in cash. So again, we had an increase in an asset, which is a decrease in cash. Here we have a decrease in an asset, so it's going to be an increase to cash. An increase in a liability is an increase to cash. Again, increase in liability, increase to cash, and then an increase in liability, increase to cash. So remember that I said we'd come back to depreciation expense? Let's go back to the income statement. So we need to adjust for any items on the income statement that are not operating activities and that are not cash activities. So depreciation expense is a non-cash item. It's just an accounting entry. No cash changes hands. So we need to add that back, okay? So increased cash. Because it's an expense, so it reduced income. So we got to increase the income to account for that cash. And then going back here, you'll see that we had two other non-operating activity items, okay? So a gain on sale and a loss on investments. Those are both investing activities, okay? So if we had a gain on our sales of vehicle, that means that income would have gone up, so we need to decrease that. And if we have a loss on sale, that means that our income went down, so we got to add that back and add it to get to our cash number. Okay? And then we're going to add all these up, and it's going to give us our cash from operating activities. Oh, this is not right. Much better. So you'll see that the net cash provided or used by operating activities under the direct method is going to be exactly the same as the indirect method. We got there different ways, but they should always be the same. Now let's look at what we do for our investing and financing activities. Okay, so under other operating information, we see here that the company had a long-term investment that was purchased for $85,000. Okay, well, it's an investment, so that's going to go under investing activities, and we bought it, so that's going to be an outflow. So investment purchase, and it was for $85,000. Okay, and that would be an outflow. Now let's look at number 2. A long-term investment was sold for $25,000 with a book value of $50,000, resulting in a loss of $25,000. All right, so we sold something, so that means we got cash for it. So sold, investment sold. Now you remember that we just care about the cash. So we sold it for $25,000. Remember on the income statement we had a loss of $25,000? That's related to this investment. But our actual cash is going to be $25,000 because the value was $50,000, but we only received $25,000 in cash. Now we purchased land for $25,000. $5,000 of the purchase was paid in cash. The remaining $20,000 was borrowed from the seller. Well, we made a purchase, that's money outgoes, so land purchased is going to be an outflow of $5,000. That means that we paid $5,000 for it. The remaining $20,000 is going to be a non-cash supplemental disclosure. So we need to say purchased land for $20,000. All right, so we purchased land for $25,000, of which $5,000 was cash, and the remaining $20,000 was borrowed from the seller. Okay. Now let's move on to number 4. Equipment was purchased for $180,000. Okay, so we purchased something. That means that we paid cash for it. So purchased. So equipment purchased, and it was $180,000. A vehicle with an original cost of $60,000 and a book value of $50,000 was sold for $75,000, resulting in a gain. So again, this is an investing activity because it's a vehicle. And remember we had that gain on vehicle of $25,000? We adjusted for that under the indirect method. But we need to account for the cash that we actually received. So vehicle sold, and it was sold for $75,000. So we're going to have $75,000 increase in cash. And now we have capital stock was issued for $100,000 in cash. So that's our stock. Capital stock is the company's stock. If we issued stock, that means that we received cash. Okay, so it's going to be cash inflow. So capital stock issuance. And we received $100,000. Okay. And then dividends of $38,000 were paid. So again, that's an equity item. It's dividends for our stock that we paid to our shareholders, so it's a cash outflow. So dividends paid, cash outflow of $38,000. So our total financing activities is an increase in cash of $62,000, and our total used by investing is $170,000. So let's look at our total cash flow statement under both methods. So this is exactly what we did under the direct method and the indirect method, and remember they're both the same. So let's capture that. Oh, 95,000 here. All right, so this is going to be, got to add those there. Okay, so you'll see 128,000 for operating. This is a little messy, but we'll just fix it right up. Sorry about that. So we're just going to copy from our investing section, capital stock here, and dividends paid here. All right, so 170, 62. Oops. I'm sorry, this is still financing. There we go, much better. Okay, so that's going to be the same under both. All right, now we're going to look at our financing. So dividends paid and capital stock issuance here. And we're going to add that up to get 62,000. So our net increase in cash is going to be the addition of our cash received from operating activities or provided by, cash used for investing activities, and cash provided by financing activities. So you'll see here that our cash balance was 110 and it went up to 130, which is a change of 20,000, which equals the change that I calculated under those three activities. And it's going to be the same under both. So hopefully that answered some of the questions they have about cash flow statements. Please send me an email if you have any additional questions. Thank you.